From the moment you click buy on your phone to the cash in your account, what actually happens in between? Billions of dollars flow through the stock market every single day. But most people have no idea how it really works. Where does your money go? Who sets the price? And how do you turn a stock into actual cash? The stock market can feel like this mysterious casino where only rich people know the rules. But here's the thing. It's actually much simpler than you think. In this video, I'm taking you on the complete journey, from click to cash, the entire stock market explained from the ground up. No jargon, no complicated formulas, just plain English. Let's go. Welcome to Faceless Millionaire, where we break down money and investing in a way that actually makes sense. Quick disclaimer, this is not financial advice. This is educational content about how the stock market works. If you want the click-to-cash journey explained clearly, subscribe right now. Let's break it down step by step. Before we get to the clicking and the cash, you need to understand what a stock actually is. Simple analogy. Imagine your friend starts a pizza shop and needs $100,000 to open it. She can't afford it alone. So she splits the ownership into 1,000 pieces called shares and sells them for $100 each. You buy 10 shares. You just paid $1,000. You now own 1% of her pizza shop. The shop takes off, lines out the door. Rave reviews. Investors now think the whole business is worth $200,000. Your 10 shares, they're worth $2,000 now. You doubled your money, not because you got lucky, but because you owned a piece of a business that grew. That's the stock market, just at a much, much bigger scale. When you click buy on Apple stock, you're buying a tiny piece of ownership in Apple, the actual company, the business that makes iPhones, MacBooks, AirPods, services. If Apple grows, if they sell more products, if they increase profit, the company becomes more valuable. Your shares become more valuable. This is critical to understand. Stocks aren't just numbers bouncing around. They're not lottery tickets. They're not casino chips. They're ownership in real businesses. Companies with employees, products, customers, revenue, and profit. When you own stock, you're a shareholder, a partial owner. If the company succeeds, you succeed. If it fails, you lose. As a shareholder, you even get rights. Vote on major company decisions. Receive dividends if the company pays them. Attend shareholder meetings. You're not just watching from the sidelines. You're an owner. Even if you only own one share out of billions, you're part owner of that company. So why do companies sell stock? Why give up ownership? The answer is growth capital, money to scale fast. When a company wants to expand aggressively, they need cash. Hire thousands of people, build new factories, develop new products, enter new markets. That takes serious money. They have three choices. Option 1, use profit. But many growth companies aren't profitable yet, and even profitable ones might not have enough cash for massive expansion. Option 2, take a loan, but loans have to be repaid with interest. Expensive and risky. Option 3, sell ownership. This is where going public comes in. When a private company sells stock to the public for the first time, it's called an IPO, initial public offering. Think of it like a grand opening sale, except instead of selling pizza, the company is selling slices of itself for the first time. Real example, Amazon, 1997. Jeff Bezos takes Amazon public at $18 per share. If you clicked buy and invested $1,000, you'd get roughly 55 shares. Today, those shares are worth over $2 million. You didn't get lucky. You owned a piece of a company that grew from an online bookstore into one of the most valuable companies on earth. Important distinction. Primary market versus secondary market. Primary market. The IPO company sells shares directly to investors. Company gets the money. This happens once. Secondary market. Everyday trading after the IPO. You buy from other investors. You sell to other investors. The company doesn't get that money. Ownership just changes hands. When you click buy on your phone, 99% of the time you're buying in the secondary market, from another investor, not from the company. Now let's talk about what happens when you actually click buy. How does the price get set? Why does it change every second? Simple analogy. Stock prices work like concert tickets. Huge band announces a farewell tour. Everyone wants tickets. Demand explodes. Sellers raise prices. Tickets that were $100 are now $300. Same band gets terrible reviews. Tour dates get canceled. Nobody wants to go. Sellers drop prices to $50 just to find any buyers. Stock prices work exactly the same way. Supply and demand. Behind the scenes, there's something called the order book, a list of everyone who wants to buy and everyone who wants to sell, with their prices. Buy side, also called bids, people willing to pay certain prices. Buyer A, I'll pay $99 for 10 shares. Buyer B, I'll pay $100 for 5 shares. Buyer C, I'll pay $101 for 20 shares. Sell side, also called asks, people willing to sell at certain prices. Seller A, I'll sell 10 shares for $102. Seller B, I'll sell 5 shares for $103. Seller C, I'll sell 20 shares for $104. A trade happens when a buyer and seller agree on price. The highest buyer meets the lowest seller. They match. Trade executes instantly. Buyer C raises their bid to $102. That matches seller A's asking price. Boom. Trade happens. 10 shares change hands at $102. That $102 becomes the new stock price you see on your screen. It's not a fixed number. It's just the last price someone agreed to pay. 1 second ago, 1 trade ago. Because buyers and sellers are placing orders, canceling orders, and matching trades every millisecond, the price constantly moves. More buyers than sellers? Buyers have to raise their bids to convince someone to sell. Price goes up. More sellers than buyers? Sellers have to lower their asks to find someone willing to buy. Price goes down. Supply, demand. That's the entire mechanism. Key insight. The price on your screen is just the last agreed price, not what the stock is worth, not what it'll be worth tomorrow. Just what one buyer and one seller agreed on right now. Stock prices fluctuate every second based on what thousands of people think the company is worth at this exact moment. So what makes all those buyers and sellers change their minds? What drives prices up and down? 4 big factors. Factor 1, company earnings, financial results, quarterly reports. Every 3 months, public companies report their numbers. Revenue, profit, growth, guidance for next quarter. Beat expectations? Stock usually goes up. Miss expectations? Stock usually goes down. Real example. Apple reports earnings. iPhone sales crushed expectations. Revenue up 20%. Profit up 30%. Guidance raised. More people want to own Apple now because the company just proved it's growing faster than predicted. Demand rises. Stock price rises. Opposite. A company reports shrinking sales. Declining profit. Losing market share. Fewer people want to own a struggling company. Demand drops. Price drops. Over the long term, stock prices follow earnings. If a company keeps growing profit year after year, the stock goes up. If profit declines, stock goes down. Factor 2, interest rates, set by the Federal Reserve. When the Fed raises rates, borrowing becomes expensive. Companies pay more for loans. Consumers pay more on mortgages and credit cards. Spending slows. Growth slows. Higher rates usually hurt stocks because slower growth means lower future profits. Also, high interest rates make bonds attractive. You can earn 4 or 5% risk-free. So investors move money out of stocks into bonds. Less money in stocks means lower prices. When the Fed cuts rates, opposite happens. Borrowing is cheap. Companies grow faster. Bonds pay less. Money flows into stocks. Prices rise. Factor 3, economic news. Unemployment, GDP, inflation, consumer spending. Good economic news helps stocks. Low unemployment means people have jobs and spend money. That's good for businesses. Bad economic news hurts stocks. High unemployment, recession fears, inflation spiking, makes investors nervous. They sell. Factor 4, market sentiment, the emotional, irrational part. Sometimes stocks move based purely on fear or excitement, not actual business performance, just emotion. Warren Buffett quote, "Be greedy when others are fearful. Be fearful when others are greedy. When everyone panics, stocks crash. Even if companies are fine, fear drives prices down irrationally. When everyone's euphoric, stocks skyrocket. Even if valuations are insane, greed drives prices up irrationally. Company earnings, interest rates, economic news, market sentiment. These four forces constantly push and pull stock prices. Understanding them helps you make sense of market movements. Now we get to the cash part. How do you actually make money from stocks? Two ways. Way one, capital gains. The price goes up, you sell, you profit, you click buy at $100. Stock rises to $150, you click sell, you just made $50 per share. Real example, you bought Tesla at $50 in 2020. It rose to $300 by 2021. You sold, 250% profit. That's capital gains. This is how most people build wealth in stocks. Buy good companies, hold for years, let price appreciate, sell when you want cash. Critical point. You only make or lose money when you sell. Until then, it's just numbers on a screen. Stock drops from 100 to 80? That's an unrealized loss, just on paper. If you hold and it comes back to 100, you never actually lost anything. You only lock in the loss when you click sell. Way two, dividends. Some companies pay you cash just for owning shares, usually quarterly, might be 50 cents per share, $1 per share, $2, depends on the company. Real example, Coca-Cola pays about a 3% annual dividend. You own $10,000 of Coca-Cola stock. You get roughly $300 per year in cash dividends, just for holding. Most investors reinvest dividends automatically, use that cash to buy more shares. This compounds returns over time. Growth stocks like Tesla and Amazon, no dividends. They reinvest all profit into growing faster. Mature stocks like Coca-Cola and Johnson & Johnson, steady dividends. They're not growing as fast. They have extra cash to return to shareholders. Both strategies work. Depends on your goals. Want growth? Buy growth stocks. Want income? Buy dividend stocks. Now let's walk through the actual click. How do you buy a stock? Step 1. Open a brokerage account. Fidelity, Schwab, Vanguard, any major broker. Takes 10 minutes. Name, address, social security number. Link your bank. Done. Step 2. Transfer money from your bank to your brokerage. $100, $1,000, whatever you want to invest. Step 3. Search for the stock. Every stock has a ticker symbol. Apple is AAPL, Tesla is TSLA, Amazon is AMZN. Type it in the search bar. Stock pops up. You see current price, chart, news. Step 4. Place your order. Two main types. Market order. Buy right now at current price. Whatever the next seller's asking, you pay. Fast and simple. Limit order. Only buy if price reaches a specific level you set. More control, but order might not execute if price doesn't hit your limit. For beginners during normal market hours, market order is fine. Click buy, confirm, done. Within seconds, shares appear in your account. You now own a piece of that company. From click to ownership in under a minute. Important warning for beginners. Don't start with individual stocks. Buying one company is risky. If that company tanks, you lose big. Even professional investors struggle to pick winners consistently. Start with index funds. VTI owns the entire U.S. stock market, 3,500 companies. VOO owns the S&P 500, the 500 biggest U.S. companies. One fund. Instant diversification, much safer. I have a complete guide on index funds and ETFs, which ones to buy, how to choose. Best for beginners. Linked in description. Watch that next. Let's recap the journey. From click to cash. You click buy. Your order goes to the brokerage. Matches with a seller on the exchange. Shares transfer to your account. You own a piece of a real company. Prices move based on supply and demand. What buyers and sellers think the company is worth right now. 4 things drive prices: earnings, interest rates, economic news, sentiment. You make money 2 ways. Capital gains when price goes up. dividends when companies pay you cash. The stock market isn't a casino, it's a marketplace for ownership in real businesses. And over the long term, those businesses have consistently grown in value. If this finally made the click-to-cash journey make sense, hit that like button. If you want more investing explained simply, subscribe to Faceless Millionaire. Now tell me, what was the first stock or fund you ever bought? Or what are you thinking about buying first? Drop it in the comments. I'll reply with my thoughts. From click to cash, now you know how it works. Time to make your first move. Thanks for watching. I'll see you in the next one.